Paychex just wrapped its biggest year ever. Revenue jumped 17% to $6.5 billion. And then management told investors not to expect that again, guiding next year's growth all the way down to 5 to 6%. That sounds like a warning. It's actually the whole story, because almost all of that 17% came from a single acquisition. Here's the top line over 5 years. Revenue climbed from $4.6 billion in fiscal 2022 to $6.5 billion in fiscal 2026. That final jump, up 17%, is the biggest in the company's recent history. But look closely. It's a step, not a smooth ramp. And that step has a name: Paycor. So what actually is Paychex? It's the payroll and HR backbone for small and mid-sized American businesses. About 800,000 clients, paying roughly 1 in 11 private sector workers in the country. It runs on 2 engines. Management Solutions, the core payroll and HR technology, brought in $4.9 billion, up 20%. And PEO and Insurance Solutions, where Paychex buys benefits at scale for small firms, added $1.4 billion, up 7%. Paychex closed its acquisition of Paycor in April 2025 for about $4.1 billion, the largest deal in its 50-year history. Fiscal 2026 was the first full year Paycor sat inside the numbers, and that's what turned a mid-single-digit grower into a 17% headline. It's real revenue, but it's bought, not organic. Now, watch what happened to earnings. On a reported basis, diluted earnings per share grew just 7% to $4.89, but management's adjusted number, which strips out the acquisition charges, was $5.51, up 11%. Same company, same year, 2 different earnings numbers. The wedge between them is Paycor. Here's where that gap comes from. Amortization more than doubled this year, from $210 million to $443 million, almost entirely because Paycor created $242 million of new intangible amortization. That's a real charge on paper. And it's why reported operating margin actually fell, from 39.6% to 38.6%, even as the business got more profitable underneath, with adjusted margin rising to 43.2%. But strip Paycor out, and the real engine was doing the opposite of slowing down. Management said organic growth, the business excluding Paycor, exited fiscal 2025 at around 3% and nearly doubled through fiscal 2026, improving every quarter. So next year's 5 to 6% guide isn't a slowdown from 17. It's roughly where organic growth already exited the year. The deceleration is arithmetic, not decay. This is why you own a business like this. Paychex returned $2.2 billion to shareholders this year, $1.6 billion in dividends, and $611 million in buybacks, and still paid down debt and cut its leverage by half a turn. The dividend alone yields about 4.2%. And it's all funded by cash. Operating cash flow rose 35% to $2.6 billion. Free cash flow rose 36% to $2.3 billion, a free cash flow margin near 36%. Return on equity ran about 45%. Those are software-like economics hiding inside a payroll company. So what's it worth? At $114, Paychex is a $40.7 billion company trading near 19 times forward-adjusted earnings with a free cash flow yield around 6%. Run a scenario cash flow model on this year's $2.3 billion of free cash flow, and the range is wide. A bear case near $100, a base case around $135, a bull case near $185. Wall Street sits at the cautious end, a hold, with targets clustered near today's price. The whole debate is whether that organic reacceleration is real. These are illustrative ranges under stated assumptions, not price targets. The biggest risk is hiding inside that cash machine. $211 million of this year's revenue, some of the highest margin revenue Paychex earns, is just interest on the client payroll funds it holds in transit. Management already guided that down 4 to 5% next year, as last year's rate cuts fully bite. A faster Fed easing cycle pulls directly on the most profitable dollar in the business. Add the risk that Paycor's cross-sell disappoints and that AI eventually pressures low-end payroll pricing. Here's the bottom line. Paychex isn't a growth story, and it isn't trying to be one. It's a defensive, high-return cash compounder, digesting the biggest deal it's ever made. Don't watch reported revenue growth. Watch organic growth and the adjusted operating margin. Together, they'll tell you whether the Paycor cross-sell and the AI efficiency story are real. Today, The market is paying a full compounder multiple and asking Paychex to prove it. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.